Okay, well, let's get started. So today's topic is, are you ready to retire? We're going to talk about a few different things in order to make sure that you have everything in order as you're thinking about getting ready to retire. My name is Misty Garza. I'm one of the financial advisors here at Bogart Wealth, and I am based in the Houston, Texas office here. So a quick little agenda as far as what we're going to talk about today. So again, thank you for joining. We're going to go through a little bit of an introduction of Bogart Wealth if you're not familiar with who we are and what we do. And then we're going to talk about an overview of things to consider when you're confronted with the question of, am I ready to retire? And then we'll talk a little bit about an understanding of creating a retirement planning process and your own specific retirement plan, what goes into that. Into those decisions and putting that together for you. So for those of you who are new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. We have a little over $2.8 billion in assets under advisement, $2.5 billion assets under management. We work with just shy of 1,300 households. We are a registered investment advisor, which means we're an independent fiduciary advisor working in your best interest. We custody all of our assets at Charles Schwab for your protection. Nothing is ever held directly with Bogart Wealth, and we're a fee-only management firm. And what that means is that the only time we get paid is on the money that we are managing specifically for you. We have a whole team behind the scenes here at Bogart Wealth. We have our team of financial advisors like myself who work directly with the clients, creating their plans and creating their retirement path or whatever their goals are that they are working on for themselves and their family. We have our back office corporate team, our marketing, our COO, our human resources compliance. We have all of that there in mostly our Virginia office as well. We manage all of our assets in-house, and we have a whole team who works on that for us. So this is a little bit about our financial planning team, our operations team as well. And then we have our portfolio management team. So as you can see, if you've been with us for a little bit, we have grown substantially over the last couple of years as well. We have 3 offices for your convenience. So we have our corporate headquarters there in McLean, Virginia, and then we have 2 offices here in Houston, the Gessner office as well as the Woodlands office. I wanted to point out a few things that we have been doing here that is relatively new. If you haven't been receiving any emails or gone to our website, we've been doing a lot of these educational webinars throughout the year, and it really has been our focus this year going forward to provide the educational content. So we invite you to join our future webinars, visit our website to look at the timeline as far as what's going on. BogartWealth.com has lots of recorded versions of our previous webinars. We also have a podcast that we do and release those as well. So a lot of content on our website. These are a few of the series that we have done or are planning to do throughout the next couple of months. And so for those of you who work with us already, you know that planning is the heart of what we do. So most people think that planning for retirement is just about the investment management piece. And we're going to show you how that is not the case when you're getting ready to retire. There's lots of different pieces that go into it and working on your goals and managing issues that are important to you. So if you haven't gone through our planning process, I encourage you to reach out to myself or one of the other advisors, and we can talk specifically about what you and your family are working towards. All right, so now let's get started. So I think one of the biggest downfalls that people have is really not creating a plan. And it's never too late to create a plan. And the key to creating that plan is that it needs to be your plan. So you individually have your own vision and your own future. It's not related to what your neighbors are doing or your coworkers are doing or what somebody else in your family is doing or looking online, reading some of those things. All of those things can help give you some guidance, but what might work for them or what's important to them is not necessarily related to what's important to you. And so really starting out with your own plan that works on your objectives and what's most important for you. So when you're working on a plan, one of the first and foremost important aspects of it is planning for current and future cash flow needs. And when you do that, that'll help eliminate some of the stress. When it comes to retiring, emotions play a huge part in this. And so sometimes the idea of retiring is very scary. Most people only do it one time. They don't go back to work again. And so it's something that you're not familiar with. And so one of the things to help ease a little bit of that emotional stress that you may feel is just making sure that you have your plan together. It can give you some confidence and some comfort in knowing that some of these issues are addressed for you. And so the first of those is looking at your cash flow needs and making sure that we have those buttoned up. Then after we have that, we work on investment strategy that helps to create that cash flow that you're working on, and that will sustain you throughout retirement. And part of that is looking at how do we do that? And when we look at that, that's our job, is to figure out what is the best way to create that cash flow. What are the withdrawal strategies? What do your spending patterns look like now, 5 years into retirement, 10 years into retirement? And so it's important to really get a feel for all of the different aspects of the plan and how those cash flow needs will impact your withdrawals, as well as making sure that we incorporate in that emotional piece of it. And again, I emphasize that a plan can do wonders for helping you feel comfortable about the decisions that you're going to make about, am I ready to retire? When can I retire? So that the goal would be, once you have your plan, then we can always update it and make adjustments. Going into the initial financial planning process and having a plan, you're not expected to have all the answers. This is the first time you've done it. And so there might be things that you're not thinking of. Again, that's part of our role. Since we've done this numerous times for our clients, we've helped retire thousands of people. And so by doing that, there are certain things that we may see or be able to give you some guidance on things that you may be missing. And so without having the guidance of somebody who works through the retirement planning process, you might miss a few things. So having that plan that addresses all of those issues is the first step in making sure that you are ready to retire. So again, kind of why is the retirement income important? How will it help you? So it will help you minimize risks that you as a retiree must address. And what I mean by that is there's lots of unknowns that may or may not happen in retirement, whether it is something that has to do with you and your family personally, if it is health related, if it's related to the market and just world events that are going on. By planning for that, it addresses a lot of those risks to make sure that your retirement plan is successful. It also helps you make informed decisions so that you can start off in the right direction. One of the we've seen some people retire and they'll just quickly, make a decision of saying, I'm going to retire because my coworker told me that I needed to go ahead, and I needed to leave because things are not going to be good going forward with whatever my pension might look like. And you don't want to make a decision in such a rash manner. You want to make sure that you're making an educated decision. And that's, again, what the plan will help you do there. And you can start potentially planning. I would say a good window is, obviously you can always start planning. So somebody who graduates out of college and gets their first job, perfect time. Again, you're going to have a very different level of planning at that point. We're just going to make sure you're doing all the things you're supposed to be doing. We're not asking, what are you going to spend in retirement? When are you going to retire? A 23-year-old doesn't know those answers. But as you go through retirement and you really start honing in of, am I ready to retire? You might know that 10 years prior, and we might want to go back in and look and see what are some things that we need to do. And then as you get closer, you'll be able to define a lot more of those. And so the third one is looking at the predictable income and cash flow You probably don't know that when you're 10 or 15 years out from retirement. But as you get closer, we start really looking at what your lifestyle is, what are your goals, what do you truly want to do? And then we really take a hard look at those cash flow needs and how do we start to look at the withdrawal rate and the withdrawal strategies to help you make sure that you are able to manage those cash flows. And then the last piece of that is just monitoring your plan and making sure that you stay on track. An important piece of it is making sure your plan is flexible. The idea that you do a plan right before you retire and never look at it again or never change it, it's not reality. Again, like I said, you don't have all of the answers. Most of the time, something in your life might change or something in the market might change. Your goals just might change. And so you want to make sure that your financial plan is flexible and that you can make those adjustments, as well as if nothing has changed, then we do want to make sure that we are still on track to achieving those goals. And I would say that if you've already retired, typically once a year is a good period of time to take a look back and make sure that you're on track. As you're going through the planning phase, as things change or as you maybe get a little bit of clarity on some of the issues that you're working on. But I would say, again, at least once a year, the market is moving, things of that nature. So still looking at that, but as well as making adjustments as your goals change as well, too. So a few things that are important to kind of help you create your own vision of your future and things that we look at when we're creating the plan. Remember, I said it's not just about investment planning. A lot of people think, am I ready to retire? They just look at, here's my net worth, here's the assets that I have. And yes, that is a huge component of it. But one of the things to think about is when I'm retired, what does that look like? And again, like I said, some people have a very clear vision of that. Other people, it's something that's created over time. So one of the things to think about is your family. How do your decisions impact those that depend on you? So you need to consider a spouse, your children, your parents. Like, what does that family relationship and what does that look like for you? Whether it is emotional support, financial support, all of those things that are there. The second one is health. I think about your physical as well as your mental health. It plays a huge part in your success of retirement. How does your health affect your spouse or those that are dependent upon you as well? A lot of people are in more of the sandwich generation to where they still have their parents and they're having to take care of their parents. And they may or may not still have children who are in high school or college or even younger than that. And so they're having to take care of two generations. And so that can obviously take a toll mentally as well as physically and financially on your portfolio. So those are the pieces that we talk about and try to make some adjustments, or at least, again, recognize those issues and address those as they come up. The other one is a home. Where do you plan on living in retirement? Are you going to downsize? Are you going to purchase a second home? Some people might follow their children around. Other people might have the RV life and sell everything and hit the road. So again, some people know that. Some people do not know that. We'll run different scenarios if people think that is an option. Or people might give us a quick call. They're at the RV show and say, I found an RV. Can I buy it? We might quickly look at their plan, look at where things are and help make decisions there. So again, something to think about as well as far as what that may look like on there. Your lifestyle. What do you like to do when every day is a Saturday and you don't have a job to go to? Where are you going to get that satisfaction in retirement? And I think this is a huge piece which goes along with the mind and spirit. A lot of people identify so much with their job. They typically will spend more time at work than they might with their family and at home. And so it can be very difficult to disconnect from that if you don't have hobbies or things that you want to do. For the first, 3 to 6 months, maybe you have an extra long honey to-do list and you have a lot of things to take care of. But once that's gone, what does that look like? Where are you going to get that satisfaction? What do you want to do on there? So that's obviously not a piece that really impacts your financial plan from a financial standpoint, but it does impact the emotional aspect that plays into creating that plan for you. And work. Some people will want to do part-time work, and whether or not that is paid, employed part-time work where you go into more of a corporate type setting, that also might be charity work that you are able to spend more time doing. So that could be paid or non-paid type of work. Legacy. Do you intend on leaving a legacy for your loved ones, and what are some of the causes? This will fall more into estate planning, and what does that look like, as well as how much do you have left over while you're working. And a lot of that could then play into what your cash flow and your withdrawal strategy is. If you plan on wanting to leave behind a legacy for your loved ones, then we do need to monitor your cash flow and your investment portfolio to make sure that you're on the right path to leave behind what it is that you were wanting to do for your family or your causes. If your goal is to spend it all, then we will make sure that you stay within those parameters and are able to achieve those goals as well. So this chart is really kind of interesting because it really talks a little bit about what some of the greatest retirement concerns are for people when they go into retirement. And it's done for people who are pre-retirement, over 50 though. So they're definitely thinking about retirement, and then looking at retirees. Clearly the number one at the beginning, but then starts to fall off, is outliving your savings and investments. And then you can see that there's a few other little issues that start to come into play that overtake that as well. And I would say that the reason why that starts to become less of a risk is that once you get into retirement a little bit, typically, as you'll see on this chart, health concerns, long-term care costs, those kind of things start to weigh a little bit heavier. Not so much about outliving your assets. You've gotten a little bit more comfortable with that. But it's very interesting to see some of these things as well. Again, healthcare is part of it. Losing my independence, cognitive decline, you'll see the pattern of that. And this can come into play with potentially when you're creating your retirement plan. If you are concerned about healthcare, then maybe we might want to do a lot, have a bigger bucket list earlier on in retirement and build that into the plan to where you may need a little bit more cash flow to do some of those things that you want to make sure you take care of, so that later in life you don't have any regrets of not taking care of some of that. So moving on a little bit to some of the risks in retirement that are there. Now, there are more than these four that are listed here, but these are a few of the bigger ones that a lot of people will come to mind very easily. So longevity. For an average couple age 65, there's almost a 50% chance that one of them is going to live until age 90. And then a 20% chance one will live till 95. So going back to that first concern that people had, as far, or the biggest concern prior to retirement, was outliving your savings. Longevity is an issue for a lot of people now. And so you want to make sure when you're creating a plan that we are not going to say have enough assets until 85. Now, maybe for you, there is a financial situation that is going to shorten your life expectancy. But for most of our plans, we are planning for longevity. We are typically planning at a minimum of age 90. And I actually do have some clients who have wonderful, longevity in their family, and we're planning to 100 for some of those individuals. So that's one of the things to think about, is that there is a great chance that you will live a long life, at least for one of you if you're married. And so we want to make sure that your assets do last for that. Now, there may be changes to cash flow, obviously, that when you're 90, you're probably not spending as much as when you're 60, but you still want to make sure we do some later in life planning to accommodate that longevity. Obviously, inflation. This has obviously been a huge topic over the last couple of years, given the current situation with rising costs of, groceries and cars and insurance and property taxes and all of that. So it is a very real risk. And a part of that can be addressed with market performance, the third one. So the idea is, depending on the size of your portfolio, and what your end of life goals are as far as leaving a legacy or spending it all, inflation may or may not have a play into what your market performance needs to be. If somebody has a substantial portfolio, their cash withdrawal is very low, sure, their purchasing power is going to go down, but they don't really need to have higher market performance if they're not going to spend it all because their goals are not too high as far as a withdrawal rate. So those will play into potentially the market performance and the returns. Sequence of returns is a very real issue that a lot of people, you'll read about it, you'll see a lot of it. And basically what it means is that the first 2 years of retirement are typically very critical as far as making sure that your accounts don't substantially lose a huge amount of value if you're drawing down on them. If it happens in the last 2 years, so if it happens at 89 and 90, not as big a deal from an end of life. But if you are taking money out of your accounts and the market is dropping 20, 30, 40, 50% in a year, and your withdrawal rate was average at the beginning, well, now suddenly when your accounts are down 40 or 50%, your withdrawal rate has substantially changed. So it's very important to make sure that that sequence of returns is not something that's missed. Now, it's not a big issue if you plan appropriately. So it's not something to be afraid of. Once we have looked at your cash flow needs and your withdrawal strategy, then we can help plan for something like that would have happened. So whether a 2008, 2009 happens, or something like a 2022 happens where the market is pulling back, very easy to plan around that. And volatility. One of the biggest risks kind of coming into retirement is bringing in that emotional piece into volatility and having to sell if you need to from a withdrawal standpoint, or just emotionally, if you are not comfortable with the volatility, then making decisions based upon those emotions during extreme volatile times of the market is a risk. And so you want to make sure that you evaluate what your risk tolerance is. And when I say risk tolerance, there's a few different ways to look at your risk tolerance. There's the financial risk tolerance, where I can look at your portfolio and say, this is where you need to be, no emotions attached, that you need to get this level of return and you are going to be fine. But then you need to take a step back and look more at your emotional and your behavioral risk tolerance. And those are super important, because I need to know when the market moves one way or the other, how are you going to feel about that? And there's two pieces to that. So the emotional side is does that stress you out? Does that keep you up at night? Do you feel very anxious and you're just not comfortable with that? And then the second one is the behavioral part. And the behavioral part is when you actually get out of the market. You said, I've had enough of this. I can't sleep. I'm done. And I want to get out. So we really need to kind of figure out, do all three of those align for you? So does the financial number make sense and you're comfortable with that? Or does your emotional and behavioral piece weigh a little bit more? And then that could impact the market performance that we're shooting for, or what's going on in your portfolio, and making sure they match. And then the last one that we have here is healthcare. So everybody knows this, healthcare costs are rising faster than everything. I would say that's not a surprise. So when we do planning, we build in a healthcare aspect of it. So if somebody does have additional healthcare needs that they're already paying for, we'll go ahead and account for those. If they don't, we do kind of use some of the basic numbers. For a lot of people, it's about $7,000 in today's dollars per person. So $14,000 for a couple if we're planning for them. And then we inflate those out higher than a traditional average inflation number. I think that's super important to plan for that, because as you can see on here, couples age 65 will spend almost $250,000 in retirement to cover healthcare costs. Does not necessarily include nursing home expenses. Now, the aspects of how many people actually go into a nursing home, there's different numbers for that. But when you think about that $230,000, that includes all of your healthcare premiums and all of the additional out-of-pocket costs, maybe a little bit of some in-home care if you need a little bit of those kind of things coming in later in life as well. So for a lot of individuals, healthcare, one, is a concern, and it may be one of the most expensive issues that you might spend the most towards in retirement. And again, all of these things are something that you reassess as well in the plan. These are all of the things we're looking at. So if something has changed in your life expectancy, if inflation numbers have changed, if market expectations have changed, and if healthcare costs or needs have changed, as we're reviewing your plan, we're addressing all of these as well on an annual basis. So kind of the final risk, which really, in my opinion, is the biggest risk, is spending. And so one of the tasks that I make my clients give me is a budget. And I don't necessarily mean a budget in the sense that I'm really kind of figuring out, where are they spending all of their money? I don't really care where they're spending their money, but I just want to know what they're spending their money on and what their lifestyle is. The idea that you're going to go into retirement and spend less, not really, right? Now, depending on how much you are of a saver while you're working, the idea is that if you make $200,000, I'm not saying you're going to spend $200,000. There's a net number. What were you putting in your 401k? Looking at what comes home to you. And then from there, what are you spending? And then if you're still saving more of that, I'm really just looking at that spend piece. But it's very important to know what your lifestyle is, because most people want to have the same lifestyle. When they retire, they don't want to have to suddenly start to budget or have to start making adjustments. Sometimes that may be a decision that they make if they're in a situation to where they just want to get out and they say, well, I'm willing to make those adjustments to get, out of the current environment that I'm in. But if we're truly just saying, I'm just going to retire, what do I want it to look like? We really want to know what your lifestyle is. And a lot of times, what we'll do is we'll go through, we'll create a budget. If you already haven't done one, we have one that we send to people that just gives kind of some categories for people. But there's two pieces that we want to look at. And we want to look at what your essential needs are. So you look at food, housing, healthcare, and insurance. You want to know if you have a mortgage, what is it? You have property taxes. Do you have rent? What are your groceries? What are those basic needs? And what's important to know what those basic needs are is because if somebody is assessing their retirement, then we want to know if the market is terrible, or you're just saying, look, I need to retire now, like, what are the things that I have to pay? What are the bills that I have to pay no matter what? And then all of the discretionary are all of the extra fluff that I call, right? But that's part of your lifestyle in retirement. If you eat out, if you travel, if you go to the gym and you have certain memberships, like, you probably still want to do that. And then a little bit of extra. If you have more time on your hands, you might have more time for those hobbies or more travel or more entertainment. So we look at those essential versus discretionary current. And then we'll look at what does it look like in retirement. Okay, so most of your essential expenses will probably stay the same. Now, maybe you relocate, you have a different house, so maybe there's a little bit of movement there on your essential. But then we look at discretionary and say, is any of that going to go away? Maybe if the kids are still home and now the kids are going to move out. So now what does that look like if it's just you and your spouse or just you alone that's there, and figure out what do my current expenses look like today and what are they going to look like in retirement, and kind of plan from there. Now, one of the things that a lot of people end up asking for is, I need to kind of have my emergency fund, or I need to have a lot of cash on hand. And the idea that an emergency fund or savings on hand changes a little bit once you go into retirement. The reason you have a savings account or an emergency fund prior to retirement is because most likely you can't access any of your funds. So you typically have it all in your 401k or your pension or an IRA. And so if you're under 59 and a half, you don't have access to those, or you don't have access potentially to just taking money out of your employer plan. And so that's the purpose of having an emergency fund in prior to retirement. Now, after we're retired, we don't necessarily need an emergency fund, because potentially, if you're of a certain age or we have certain dollars set aside, all of your money is accessible at that point, or to some certain level. But what we do look at is maybe there are still things based upon your current lifestyle. Maybe if you have an older home that always has things going on, or you need a new car, but you just haven't bought one yet, and you might need to do that. So we can still plan for a little bit of those unexpected expenses or additional support for elderly parents, things of that nature. So there may come up with some of those that we might add to the plan as well for individuals. Again, this is the part that's extremely tailored to you, and making sure that we're looking at what does your retirement look like within your family obligations and what you're wanting to do. And then the last one on a spending perspective is, do you increase your income annually for a cost of living adjustment? So inflation. Now, when we do our plans, a lot of plans, when I've seen them, they're ours as well as other companies that I've seen, most of the plans will assume every year you have an inflation protection that increases your annual spend. So let's just say that your spend is $100,000 a year. It's going to say then you have 103 next year, and so forth. So it builds that in. But in reality, typically the way that works is that you kind of absorb that a little bit. And even during the last couple of years, when we've had this higher inflation, when people feel that inflation is the biggest risk for them, and they're very concerned about inflation, most of the people who were already retired during the last couple of years, they weren't calling me every January to say, hey, can I get my inflation, increase this year? They kind of absorbed it a little bit. And so when you do the plan, you don't want to ignore inflation. You don't want to make sure it's too low or too high, because it has a huge impact. But the plan will typically assume that it's in there. And that makes it naturally, in my opinion, a little bit more of a conservative plan, which is what you want. But in reality, the way that it works is that at some point there comes a time to where you're like, you know what? That $10,000 a month you're sending me is just not going as far. Or maybe my hobbies travel's a little bit more expensive now, given everything. So sometimes we'll just kind of adjust as needed on inflation. And like I said, a lot of people, you don't really think of it that way. You just assume that inflation takes a much bigger toll on your portfolio. But again, in such high inflationary times that we've had, people just kind of absorb those costs. So it wasn't as if they were suddenly having to go in and increase their spend by 8 or 9% based upon whatever the inflation numbers were that were coming out. So again, something to kind of keep in mind as well when we're working on your plan. So again, kind of going through what the retirement income planning process looks like. Now, this is what our process looks like, but in reality, I think with any plan that you're doing, this is what it should look like as well. So we have it in 4 parts. You have the retirement analysis, which is the plan. Then we have the investment strategy based upon risks. And then we have the withdrawal strategy, which is how do we recreate your paycheck using parts 1 and 2. And then monitoring and reviewing it based upon your changes and market changes going on in the environment. So let's talk a little bit about how those pieces are, and again, kind of what goes into each one of those. So again, kind of that first step is going back into that budget, analyzing where you're at today, also identifying the any kind of income changes. A lot of people have heard of the go-go, slow-go, and no-go period of time. And if you haven't heard about that, what that means is when you're younger and you retire, you typically spend a little bit more. You're more active, you're on the move, and then things slow down a little bit. And then suddenly you may hit a point so where it's just really not as easy for you to get around, or you just don't have the desire to do as much, whether it's hobbies or travel or whatever your expenses are, even if it's just eating out, you don't feel like doing as much of that. So a lot of times for people, we may, in their plan, increase their additional spend in those, earlier years, and then we'll back it down a little bit, and then we'll get it more to a consistent level in those later years. Again, very dependent upon the individual and how they want to plan for that. And again, like I said, looking at those essential expenses, your discretionary expenses, and anything unexpected. One of the things that might fall in here is if there is an inheritance that might come in. It depends on what that looks like, on whether or not we include that in a plan, and the dollar amount. So that's, again, one of the things that we focus on to say, are we sure that that's happening? What does that look like? And do we want to include that in our plan as well? And the whole idea of this is we just really want to be realistic with what the numbers are, because this is really the basis of the plan. So if we don't really feel comfortable or agreeable that when we put these numbers in, when I present the analysis and the plan, you might not believe it, because you're like, well, I don't really feel that $100,000 is my goal to spend. So I don't really know if the rest of this, it is important or going to come to fruition. So that's why this is something that we focus on so much with creating that initial plan. And again, there might be some different iterations that might come through as we run through this. And part of what we do as well too, because we've done this a lot, we can help you kind of work through this of what budgets typically look like for retirees. Are you missing anything? Or does something look a little off as well too? So we're going to give you that guidance on helping you create this. So then we look at some of the things that we look at within the plan that we're going to assume as well is, again, like we talked about, inflation assumptions. We're going to increase your healthcare costs a little bit faster than the traditional inflation. We can build in extra costs for later years or long-term care issues as well, if that's something somebody asks us to do. We're going to identify all of your income sources. Everybody has different sources of income. So Social Security is a piece pretty much for everybody. There may or may not be any employer pensions. And so this can be helping people decide whether or not they want to take a lump sum versus taking a monthly annuity, what makes the most sense for them, not what your coworker did or your neighbor told you should do. How does it relate, and potentially showing you different options to help you make an educated decision on when do I elect Social Security? When do I elect my pension? How do I elect my pension as well? And then we'll look at your personal savings, personal investments that you have, if you have any rental or business income, whether it is going to be for a short period of time in retirement or throughout retirement. And then if there's any part-time employment that might come in as well too. So those are the things that we're going to look at and determine if there's something that we need to adjust or change. So we're going to put all of those things in and then run your plan and see what the outlook looks like. So when we think about looking at the plan and how long do portfolios last and do I have enough money to retire, a lot of news gets put on a safe withdrawal rate, and people will either say a 3 or 4% withdrawal rate is always good. A lot of it does depend on how old you are when you go to retire and what a safe withdrawal rate is for you, as well as what does that end of life planning look like? If your goal is to leave money behind, you may or may not be able to have a higher withdrawal rate. If you want to spend it all, you can afford to have a little bit of a higher withdrawal rate. But what this slide shows you is, again, we have a few different assumptions here. You have an investment return of 5%, you have inflation of 2%, and a different withdrawal rate. So we have a 3, 4, 5, 6, 7, and an 8%. So what this shows you is that if you have a 4% withdrawal rate, that's safe for a 60-year-old individual, because that means that you can live to 100 and then some without running out of money. Now, again, we have to make sure we have the appropriate investment returns to do that, but it's a very safe withdrawal rate. The higher your withdrawal rate is, then the less years that's going to work for you. So a 5% withdrawal rate is good for a 70-year-old because that would essentially get them to 100. 6% would be good for an 80-year-old. Would get them to just over 100. Now, so 3% is typically 3 or 4 is, I think, usually what I always hear people relate to. But if you typically have a 3% withdrawal rate, you're not going to outlive your money there. Now, I want to show you that even if we change inflation, because most people would say 2% of inflation may or may not be what the average would be going forward, as long as we get 3% over inflation, this chart still works. So if we adjust inflation to 5% a year and we get an investment return of 8%, the numbers still play out on there. They don't really change too much. And one of the things that you can look at is typically during years of high inflation, the market has done well. You look back at the 80s, very high inflation, stock market did well. Over the past couple of years, the stock market has done well. You know, obviously volatility is there, but it's not as if we are in a huge negative slide with the market to where it's not possible to be able to continue to get returns above inflation. Okay. So the second step is creating your investment strategy. And so a lot of this has to do with understanding your risk tolerance and which of these investments are most appropriate for you based upon the rates of return that you need to be successful, as well as that emotional and behavioral piece that we talked about. And so some of these you may or may not already have when you think of annuities. This could come into play with your pension strategy when you have the option to choose it as an annuity versus a lump sum. Now, again, most of those are typically going to be in a fixed period of time, but it is an investment strategy for people if they if that was something that was suitable for them. There's bond ladders out there. There's income-oriented investments, so dividend-paying stocks, preferred stocks, MLPs. This is where a lot of people want to do what we call more of an income-only strategy, where they want to look at their assets and just take the income off of it and not have to worry too much about selling anything. And then we have a fixed asset allocation to where you just have your money in an account and in a certain strategy, and you just take money out of it and then just rebalance as the account balances move with your withdrawals. And then more of a dynamic allocation strategy, which is where you are rebalancing your account and managing your account based upon current risks in the market. So maybe it is related to geopolitical risk, current economic cycle, business cycle, all of those kind of things in that scenario. A question just came through that I want to get to. It says, does the 5% investment return include the 2% inflation, or do we need a 7% investment return in that scenario? So let me go back here. This means that your own personal investment return is 5%. So that's it. And it just says in the background, there's a 2%. So basically you really just need to get 3% over inflation. Okay. So that 5 is just your own personal return, not then having to include inflation. So same thing here when I'm looking, wrong way. When I'm looking at this. So again, this would assume if inflation is 5%, then you personally just need to get 8% off of that. Okay. All right. So a little bit of kind of going back to this investment strategy piece here. Again, not all of these are appropriate for everybody. Everybody's risk tolerance is different. Everybody's goals are different. Everybody's comfort level. Everybody's portfolio looks different as far as what assets they currently have. So this is just kind of encompasses all the different options essentially for people and what they can use and things that we are looking at as advisors to help figure out what's the appropriate investment strategy for you. So for a lot of people, there are typically 3 ways to create a withdrawal strategy. The first one, and this is going to be outside of Social Security money and pension money. So if you already have a certain number of dollars coming in, and then you have your portfolio that needs to generate an additional cash flow for you on a monthly or annual basis, this is what we're talking about here for a lot of people. So if I need to generate an extra $5,000 a month for somebody, what are some of the approaches? So the first one is income only. And like I briefly mentioned there, that's really about buying investments that spin off dividends or income. So that could be individual stocks, that could be individual bonds. Right now, money market accounts have been spinning off a decent amount. That's not going to be something that is consistent and always going to be happening. But the idea is that if somebody wants to just do income only, then we look at what their withdrawal rate is and is it feasible? Income only is not feasible for everybody because depending on what your income need is, we may or may not be able to get that additional interest and dividends from those investments to generate what you need. Now, it can be a component of it as well, but it may not be 100% income only. Some of these could kind of blend together as well. And then the second one is the systematic withdrawals. Basically, the easiest way to describe this would be, you have your portfolio, maybe more of a moderate, balanced portfolio, and you just pull money out kind of systematically throughout a few of those pieces, and it just covers your cash flow needs that you have there. And it's just more of a monthly draw on there. And then the last one is a bucket approach. And the bucket approach is creating specific portfolios dedicated for different time frames of your cash flow and your needs. And it really helps people accomplish a little bit more of the comfort of knowing that they have dedicated sources of income that may or may not be subject to huge investment volatility pieces in the market. It really gives a comfort and a peace of mind for a lot of people to do the bucket approach, again, depending on what works for them. So for example, let me kind of give you a little bit more because the bucket approach for some people can be a little bit harder to understand. In this scenario, somebody has about $1.5 million. They need about $60,000 a year. So their withdrawal rate is not high. So it's very feasible, but they don't want to do income only. They don't want to do some of the other ones. And they feel like they want to have a little bit more of a peace of mind, a little bit more guarantees in the market and not be subject to that volatility. And so what this shows you is that we'll break it up into buckets. And everybody's buckets, they don't necessarily have to be 5 years here and 7 years here and the rest here. Again, this can be more related to what type of accounts do you already have, what's your risk tolerance, and what is your withdrawal rate as well. So in this scenario, I would say that this person is relatively conservative to moderate, has a little bit of concern with the market and would want to have a little bit more of a peace of mind. So we put about 5 years worth of cash flow in something typically that's not going to be negative. It's always going to have a positive rate of return or a positive yield, going to be out of the market volatility. For like right now, that has been using money market accounts and cash, CDs, as well as any other cash like of investments, as well as maybe some high grade bonds, treasuries, things of that nature. So basically the idea is that in bucket one, we really have no risk associated. So this is what gets back to that sequence of returns that we talked about as far as market risk and what are some of those things that can be detrimental to our portfolio, is that this helps protect you against that, because this bucket one is not something that's going to be subject to any market movement. Now, the idea is that you're going to be spending down bucket one. Okay, so you're not just living off of this. The idea is that after year one, you have 4 years left, so you only have about $240,000, and we're spending it down. And then we look at bucket two, and again, depending on the risk tolerance, how big does this bucket need to be? It may be 5 years, it may be 7 years. In this scenario, we have it more about 7 years. So we've put about close to $500,000 into this bucket. We've given a little bit of inflation growth on there as well. And we're creating a much more moderate portfolio with this one. So there is going to be some market risk because it is going to have bonds and some equity type positions. So there will be some movement, but the idea with bucket two is that you don't need it tomorrow. Okay. So you do have time for the market to recover in that situation. So in this situation, you don't need it till year 6. Okay, so you may be able to see those fluctuations depending on how much growth and equity exposure we want to have. But the idea would be that you put that money in there and it'll still be there for you in year 6. And so we just kind of have to know that out of sight, out of mind, it's going to be okay. I don't have to worry about what it may or may not be doing from a fluctuation standpoint. And then bucket 3 is long term. When you have 10 plus years, 13 plus years in this scenario, you're good. You don't really have to be concerned about drawing down any of that money at the wrong time, because as long as you haven't made any concentrated stock positions or really done anything to, kind of increase your risk tolerance, the market has always recovered if you stayed the course. And so in this situation, that money would be there and would continue to grow. Now, throughout this process, one of the things that we do is it doesn't necessarily mean that you spend down years 1 through 5, and then you go to 6 through 12, and then suddenly at years 13, all you have is this bucket left over. The idea is that if this works really well, and depending on the environment, is that you may always keep 5 years worth of income in bucket 1. So that once you've spent down year 1, if the market did really good, then you know what, we might go in and grab something from bucket 2 or bucket 3 and refill and keep that and kind of rebalance. But what this allows us to do is that if the market is not doing good, then you know what, we don't replenish that first year. Okay, we go back in and we move it, so that after we've potentially moved through this situation, there have been a few years to allow those things to recover as well. Okay. Let me check on a few questions that have been coming through here. Let's see. One of the questions is Bogart's fee included in the investment return? All of the things that I'm discussing here with expected returns, no. So nobody's fee, whether it's Bogart's or somebody else's fee. And that is just going to be more of an annual management fee. When you look at market returns, if you're using an ETF or a mutual fund, those internal expense ratios are already net of those fees. So the only fee that would be what you would pay to an advisor, whether it's us or somebody else. And then, do you recommend having a certain percentage of money to have in savings before retiring? It depends on which approach we're wanting to do and how old you are. If somebody obviously wants to have money in savings, and I'm assuming the question is related to having something guaranteed or a little more conservative, some people might already come to us and they might already have bucket one filled. Right. And so that might work for them. Or maybe they have bucket three filled with certain pieces. And so one of the things that we can do is when we're looking at that investment strategy and your withdrawal approach, looking to see if this is the way we want to go, what buckets do we need? And part of that can also relate to how old you are when you go to retire. If you're retiring prior to 59 and a half, we need to make sure you have access to some of your money if it's all in IRAs. So there may need to be additional savings that if I am working with somebody who's 50 and they're going to retire at 55, then I need to make sure that when they retire at 55, we have things in place. So my bucket one for them to retire might be, savings for purposes of that to make sure that it's accessible to you. So it's not in the sense that it is, you need to have savings in cash before retirement, because it also can just look at the bigger picture of where your money is and what are we going to be accessing. One of the things a lot of people will forget when they think about retiring and where their money needs to be, if you have a pension coming in, we work with a lot of people who have pensions coming in, and if there's a lump sum coming in, that essentially is more of a fixed asset. So it's very conservative in that approach. So I might have their 401k very aggressive. Right. And they might think they need to pull back on their 401k. But if I have a pension that's coming in, and maybe it's subject to interest rate risk or some of those kind of things, but it's not going to go away and it's not going to be subject to the market movement, then I'm going to look at that as savings, right? Potentially if I'm electing it, and then I can look at other things. So again, kind of figuring out what do you have currently and where are those going to go? Again, very specific to each person because everybody's retiring at different times, different ages, and account restrictions and different situations as well on there. Let's see, what else do we have? One of the questions is, do we have does Bogart Wealth have an investment strategy? We have different portfolios that we work with that our investment team manages. So when we're working on all of these kind of things here, so for instance, well, let's go back to this. So an income only strategy, we have income only strategies for people. Okay, so our portfolio team does have that. That is something we provide. And then when we look at systematic withdrawals, yes, our different portfolio mixes that we have work with systematic withdrawals. And then when it comes to bucket approaches, yes, like we have all of these things that can fit in as well into all of these different buckets. And again, we can accommodate as well too if people already have outside investments that they like, or if they're using just another advisor to kind of do different pieces. Like we can work around what your goal is. If there's certain pieces that you want to continue to manage yourself and you want us to take over a few of those approaches, we'll kind of incorporate all of that together. We have individual stock portfolios and we have ETF mutual fund portfolios as well on there. So you can always reach out to me or to somebody on my team as well, and we can set up a time to kind of go over what the approaches are as well. They're not all appropriate for everybody. Again, like we said, there's not a one size fits all for here, but we definitely have some information on those portfolios that we could definitely share with you on there. Let's see. And then somebody asked, in the example above, do we need to get a 6% investment return, assuming a 1% fee in order to keep on track? The answer to that would be yes, right? So if your investment return, you need to net that 5% or that 8% or whatever number it is that you're looking at. Now, when we report for our clients who work with us, when they log into their Black Diamond portal, or when we're having our reviews and we're looking at investment performance, those numbers are already net of all of our fees. So you don't then need to go in and say, okay, you need to take that fee off of that. But if you are looking at any of our portfolio returns that we will share of just a basic portfolio return, then you will need to take off whatever your management fee is off of that as well too. Let's see. Okay, perfect. And then I know somebody asked, how do I get started with Bogart Wealth and the retirement planning process? I'm of retirement age. I have younger children, hope to work as long as possible to put them through college. I mean, and it's just, so how do I get started, whether it's with us or somebody else, is really, I mean, it's never too late, never too early to get started. So at this point is really, working with us. You can reach out to us and, we can set up a consultation. That's really what we do with people who are not currently working with us, is we just want to know what you're working on, give you some guidance, and making sure we're the right fit to help you manage that. And you want our help to go through some of these things on there, and to make sure that you're thinking of all the things that are there. And like your situation, the person who sent in this comment, is very different than other people's situations. So you do want to make sure that when we're getting together or you're meeting with somebody, that they're just specifically looking at the issues that you have mentioned as well too. Still, like we talked about, you're maybe a little bit in that generation to where you're going to be retired and you're still going to have kids at home. So, that's a very real issue for a lot of people. And so we have people in that situation all the time too. So it's not unusual. So we definitely would work on, what does that look like? What do you want that scenario to look like? As well. Let's see if there's anyone. And then somebody asked, does bucket one in this have to be after tax? No, it doesn't have to be. It depends on your age. I would say that if you are under 59 and a half and you're retiring at 55, then it needs to be something accessible, and that may or may not be after tax for you as an individual. Now, some people work for companies that once you separate from service after 55, you do have access to your 401k. Okay, so that's going to typically be pre-tax dollars that you have in your 401k. So that could be bucket one if you're 55. And we will use if everything you have is all IRA money or pension money that you're not 59 and a half yet, then bucket one may be your 401k. And so we have to work around their parameters. Everybody's 401k rules might be different. So we have a lot of ExxonMobil clients. And so Voya allows them to take one distribution a year out of their Voya savings plan prior to that. So we'll use that as a strategy for bucket one if they don't have anything out of there. Other 401k companies have other, provisions on how they allow those separation of service after 55 withdrawals. So they may be more flexible, where you can withdraw 4 times a year or whenever you want. And then I've actually seen some plans that after age 55, it's all or nothing. So if you need to take a withdrawal, you have to take all of it. But the answer is that bucket one doesn't have to be after tax money. But when we start some of the early planning, one of the parts of when we're looking at your withdrawal strategy and how we're creating it is we're looking at the sources of your money and how do we get access to that money. So for some people, it does need to be after tax dollars. So one of the other things when we talk about that withdrawal strategy and kind of managing all of that, even going through the bucket strategy or income only strategy, one of the things that we look at and again, working with you is, what account to distribute from first. Do I use my non-qualified money? So do I use my savings money first? Do I use traditional IRAs? Do I use Roths? Again, there's not a one size fits all. That's our job to look at where the current tax laws are, how old you are, where your accounts are, what your goals are, and create a plan that makes the most sense for you. And it could change year by year as your spending levels might change. If your spending levels go up, then maybe you need more, and that might increase your tax bracket. Maybe that's not the best thing. And so maybe we need to refocus on where we're taking those from. Or if tax brackets are lower, we want to make some adjustments to go through a few things. So we'll kind of analyze that. We'll start out, but then we'll analyze that as things change with tax laws and your spend levels, and adjust that as well as those goals too. I can definitely say for a lot of individuals, if you're under 59 and a half, we are typically looking at brokerage accounts, and then we're moving to traditional IRAs, and then Roths are typically the last piece that people end up wanting to touch. But if you're in a really high tax year and you need some funds and you don't want to pay taxes on it, Sometimes it may make sense to use some Roth money. So we kind of work through that there. One of the things that we also look at when we're doing the plan is managing your required minimum distributions. So these have changed over the last couple of years as far as ages. So for people who were born prior to 1960, age 73 is their required minimum distribution. If you're born after 1960, it's currently age 75. This does not pertain to Roth IRAs, so this is just going to be all of your pre-tax dollars in your plans. And so this may or may not be something that somebody's thinking about, but when we're planning for it and we're looking at where all of your assets are, obviously you have to start taking required minimum distributions at 73 or 75. But when we're looking at your withdrawal strategy and deciding where to pull money from, we want to be cognizant of what the potential tax consequences are later on down the road and what those required minimum distributions might look like. They may be your current distribution rate, and it's really not a big deal from a tax standpoint. But if you had a lot of brokerage dollars or non-qualified money that you were drawing from and you never touched your IRAs and suddenly you're 73 or 75, those required minimum distributions could be huge. So again, part of the planning, where do we take some of that money from? If I want to minimize required minimum distributions at 75, then I'm bringing those in potentially of looking at where are we taking money from prior to that so that we can make sure that we are not paying more taxes than you need to. So again, that might be converting to Roth IRAs. That might just be living off of some of your IRA assets as well. And then there is a component that if somebody is charitably inclined, we will look at doing the qualified charitable distributions out of your IRA that start at 70 and a half here. So just an extra little tax strategy. So those are some of the things that are going on in the background when we are looking at your withdrawal strategies and your investments of thinking of tax planning. It's kind of a part of that naturally for us. And an individual may or may not be really thinking about what that looks like for them in that sense. So the last step after that is really reviewing and monitoring your progress. So this is, again, super important when you think about looking at where you're at and what's going on. And you've created that plan, which is the hard part, quite honestly, getting all those numbers together and really focusing in on some of those initial goals. And then after that, it's a little bit easier. And maybe the first couple of years, you still haven't gotten comfortable with it, or we're still tweaking it or making some changes. But then after that, typically the review and monitoring of it becomes a lot easier on you. So a few things we're looking at when we're reviewing it and monitoring your progress is we're looking at your asset levels. So are they higher than or lower than what we thought? Your income, did we estimate pensions, Social Security, part-time work, business, rental income? Did all of those things, match? Spending, was it more or less than what we thought? Did something else change? Your portfolio, how was the market? Withdrawal rate, how did that kind of work out? Again, was that assumption correct with what we thought we were going to need? Really just comes down to the spending part. Inflation. This is the part where we talked about, did the market increase to where you need, the inflation increase to where we need to get a little bit more money, every month. And then your retirement goals and expectations. Has something changed, right? Are you, now going to move somewhere else, or are we going to do something else in retirement? So those are some of the things that we look at there to make sure when we're reviewing that and asking you about that. We know a lot of these kind of things. So like for spending, like I know what we went into the year of expecting our spend to be. And then I can look back and look at what we spent and I can match up those kind of things. Some of those things, though, there's pieces of it to where your retirement goal, right? Like those are the conversations that I'm having with people to say, how was your first year, or how was your second year? Or is there something else that we need to be doing? Because I can look at the numbers and I know what that is, but I don't know how your overall retirement planning, as far as what are you doing every day, what do you want it to look like, goes. So again, bringing those kind of things in to it as well. So a few things that we're specifically looking at when I'm doing that review and kind of monitoring that progress. So when I'm looking at the spending strategies, when I'm tracking the success of the portfolio, I'm really looking to see if you're ahead or behind. Okay. And a part of that is obviously it's two components. It's what did you spend and what did the markets do? And so when we do our analysis, or when anybody does any analysis, it'll show at the year end, like what your investment portfolio balance should be. And so if it is behind where we thought we were going to be, then the question is why? Did we spend too much? Then we spend more than we expected. Not that we spent too much, but more than we expected. Or did the markets do worse than we thought? And then the flip side is that if you're ahead of schedule and you have more than what we had in the plan, why? Did you not spend as much as you thought, or did the markets outperform a little bit better? And so then the question becomes, in that sense, is that that could come into that could change our investment strategies. That could change some goals. So a lot of people will say, if my portfolio is ahead of schedule, then maybe I can accelerate that home renovation that I want to do, or maybe I can gift to my children this year because the market did better, or I didn't spend as much. So a lot of that conversation comes to when we look at where you are, after that year and in tracking it going forward, are there additional things going on? And in years where either you didn't spend as much or the market did really well, then we're having those conversations to say, does that just give you a little bit extra peace of mind that we're ahead of schedule? Or does that spark the need to really have a conversation about what are some of my other goals that I want to do? Or again, like I said, accelerate some of those. So that's what's important about kind of tracking where you're at and then reevaluating your withdrawal strategy. Are we happy with what we're doing after whether the market has moved and that might have changed our comfort level, or just your overall comfort level with whatever strategy we may or may not decide to go with? Are we still okay with that? It happens where some people will start out in one direction with a certain strategy, and then as you get older, then your risk tolerance changes or your goals change. And so sometimes we do need to reevaluate that withdrawal strategy and make sure that it stays in line with what you want to do. Nothing wrong with that. The market is always changing and your goals are always changing. So we want to make sure that that still matches. And then investment strategies as well. Again, evaluating that risk. How do we feel about what was going on? Are we still okay with the current strategy that we're using, whether it may be income only or the bucket strategy? Do we need to rebalance a few things? What does that look like as well too? So those are all of the things that are going on when we are reviewing and monitoring that will keep you on track. So in the sense that, am I ready to retire? This is definitely, am I okay? Am I still okay throughout retirement? This is really what we're focusing on and fine tuning, that we are not surprised by anything going on there. A question came in and says, do we withhold tax on distributions? We can withhold tax on distributions from IRAs. So if it is just a regular brokerage after-tax account, the answer to that is no. We will work with people and help them make sure that they understand what some of the estimated tax payments need to be on a quarterly basis, but we cannot make those for them. But if it is something that is an IRA related distribution, yes. Now, do we have to? No, we do not have to withhold anything. So I have some people who are in, different tax brackets, and they may or may not have a tax liability. So we can withhold, or we can withhold at different levels for them. Now, if you're withdrawing any money from a 401k, they do have a mandatory 20% withdrawal from a 401k. So we will have to work with some of those kind of things if I have a client who's utilizing that strategy there. But typically, most people are going to owe some money on their IRA distributions. And so we'll figure out what the appropriate tax withholding amount is on there. Okay. So bottom line out of all of this, really, hopefully that you got from this, is it's just really important to have a plan when you're going through here and know what you're going to do. Again, I think it's super important to make educated decisions on all of the things that you decide to do, on how to elect your pension, how to elect Social Security, how do I take money out of my account, all of those things, very specific for you. And so all of those decisions you make on those type of things impact the bottom line of whatever's going on in the future. So we just want to make sure that you understand all of those kind of things and what those decisions can do to your plan so that you can stay on track. So again, one of the things that we look at, and we just kind of let people know, like, what should you be looking for when you're selecting an advisor? as well. Sometimes you'll find online that'll say, 10 questions to ask your financial advisor or when you're interviewing an advisor. But, coming from where we're at is what we provide for our clients here is, we're certified financial planners here. We know your retirement plans. We know the IRS rules. Now, specifically, I don't know all of the IRS codes, but we have a tax team who works with us, and we are members of EdSpot. So we have lots of things going on that we work with, knowing what the restrictions are and what the rules are, so that we can stay current on withdrawal strategies and rules to make sure that those are applicable to what you're doing. Navigating multiple business cycles as well, knowing how that plays into that, manages the portfolios for you. Again, we have our investment team in Virginia who manages those daily. That's an all-day task, not something that I think an advisor can manage portfolios and also work with clients and create plans and do all that kind of stuff. And so some of the things too is when you're looking for an advisor, you want to find somebody who discusses various strategies with you. Now, I might go in and work with the client and I know in my mind what they should do, but obviously my job is not to say this is what you need to do, right? And that's it. Like, I need to, again, like I said, let you know of all the different options so that you feel comfortable with the decision that you're making. Now, I can let you know that I think this is the one you should do, or this is the one that I recommend, but we're obviously always going to be open and showing you different strategies. They may or may not work, but sometimes there can be other options for you as well. So you want somebody who's going to be very open with discussing those as well. Provides financial planning based upon your needs and your risk tolerance, and provides regular portfolio performance reporting, and somebody who you get along with, right? That speaks in a way that you understand. I have lots of clients who are very analytical, so they really want to get down into the numbers and the weeds of things, and that's perfectly fine. And then I have other people who say, just give me the high level piece. Like, I don't need to know what's going on. That's why I have you to do that. So you want to make sure that you have a relationship with somebody who gives you what you're looking for and that you feel comfortable with in doing that as well. So one of the things that we offer here is our one-on-one financial strategy sessions. So if you feel that if you are not currently working with us and you would like to have a conversation with myself or somebody else here within Bogart Wealth, reach out to us. Let us know. You can go to our website at bogartwealth.com and you can find all of our bios. We have some videos on each one of us, and our contact information on there as well. So you're more than happy to reach out to us via email or via phone and schedule something. Or if you just have some questions as well too, please feel free to let us know. We're definitely here to help you. Again, here's all of our contact information that you can find on our website as well. We will post this webinar on our website within a couple of days. It will be posted there, so you can look at any of these slides again or watch that again as well. So I want to thank everybody for joining us today as well. I appreciate it. I'm going to kind of go through and make sure that we have all of the questions answered here, that I didn't miss anything within that. I think I got all of the questions and I don't see anything in the chat room. Perfect. Well, I'll give everybody a couple of seconds just to see if they have anything else that they may have questions on. But otherwise, I appreciate everybody for joining us. Again, you can find lots of content on our Facebook, LinkedIn, Instagram, YouTube. We have all of those things with our podcasts and everything linked on there. And again, another comment coming through. So thank you. I appreciate all of the positive feedback. If you have other people who were not able to join this, like I said, it's going to be posted on our website. Or if you know of anybody who needs some help, please feel free to pass on our information, and we're more than happy to take care of everybody. So I hope everybody has a wonderful day. And if you need anything, please don't hesitate to give one of us a call. Thank you very much.